What we want to do today is pick up the discussion where we did last time. If you remember, we talked a little bit about history of banking. I started off by saying how we had this huge number of banks in the United States. How did that come to be? And so anyway, and we had talked about the first bank of the United States. The first bank of the United States, you know, it was a privately owned bank. It was operated for a profit, but in a sense, it operated as a central bank. And there really was not a clear understanding in those days of what a central bank was, but it was served as a government's bank, and it held reserves for other banks, and it just performed several functions that nowadays we'd say, oh, so that's a central bank. You remember 1791 is when it was chartered. It received its charter from the national government in Washington, D.C. All the other banks in the United States were chartered by states at this time. Okay, and it received a 20-year charter. So this would be, take it to 1811. And the idea would be that after 20 years, then that charter would be extended and it would go on into the future. The only thing is, what happened during this period, during this 20-year period, is the first bank of the United States, some people said, played political favorites. It would be easier on giving loans to people and companies that were favored by government, and then a little bit more difficult for the other people and companies in terms of not granting loans. What it would do is sometimes it would receive currencies that were issued by other private banks and then rush right over there to those private banks and present the currency and say, we want gold, and put those banks out of business if they couldn't produce the gold right then. And so there were a number of complaints about this. There was one level of complaint was just, hey, this is a bank chartered in Washington. It's sort of this huge bank, lots of financial and political influence, and we're against that as Americans, and so we're just against this. So anyway, a big movement developed over this, and there was opposition, and so the first bank of the United States did not have its charter renewed. 5 years later, there was another attempt, and this is where we were going to pick up, with the second bank of the United States. And so a second bank was chartered in 1816. And the idea was, we'll give it this 20-year charter. There was a real, I mean, this is not how we would do it nowadays. Nowadays, we would pass a law and say there is a second bank of the United States. But in those days, it was like, this is kind of experimental. This is kind of shifting a lot of power to Washington. Let's give it a limited charter. And then if we like it, we'll renew that charter. And so its original charter took it for 20 years to 1836, with the idea that if this is successful, we'll renew the charter. Well, really for many of the same reasons, there was this political turmoil and controversy and so forth. And Andrew Jackson came to office as president, and I believe in 1828, I could be wrong about the year, that's not really the key here. And he basically said, I'm against this. And he had the ability, well, he was against it. The Congress passed a law issuing a second charter of the Bank of the United States. He vetoed that. And then they were not able to pass that over his veto. I think in 1832, if I'm not mistaken, is when they passed a law extending the charter, and he vetoed it. And that was just the end of the story for the second Bank of the United States. And there never was then a reissuance of the charter. There was never a third Bank of the United States or anything like that. These banks had federal charters. And a charter is a license to operate. And they were chartered explicitly by the Congress, Act of Congress. They passed the law. At the same time, we had state chartered banks. By the way, let me just go back and say one more thing. It is problematic when you have a bank that has shareholders and it's operated to earn a profit, and it is the only bank that has a federal charter, and it does receive government deposits, and it is making or easier to make loans to friends of government. There are some valid complaints to be made there. We would not permit that today. And so it's not like, oh, these are just cranks back there, 200 years ago, and they didn't know what they were doing. I think they had some valid complaints, and had these powers not been abused and so forth, there's a very good chance this would have been renewed. The Congress did renew the charter for the Second Bank of the United States, but Andrew Jackson, who was from the South and who was, tended toward this populist point of view, he was very suspicious of this concentrated power and this power being used to favor some people over others. And so that's where the veto came from. And as I say, we would never stand for that now. Here's the thing that we had, though. Yeah, a couple of banks with federal charters. We've got state-chartered banks. Each state is issuing charters to banks, and so what happens is we're getting lots and lots of small banks in the United States. This was consistent with this whole idea of small government, local government, federalism, and so forth, is, hey, if you want to do business as a bank, if you want to do business, you want to have a gas station, or you want to have a beauty salon, or a grocery store, you'll incorporate, you go to your state to get a license, right? And I don't mean to say a license to sell groceries, but to get your charter for your corporation that operates that grocery store, you go to your state government. And all they were saying is, let's let banking be handled the same way. And then the laws that govern how those banks behave, whether they can make loans or can't make loans, or whether they're solvent or insolvent, and so forth, those laws will be made at the local level. Not local within your city, but within your state. And so what's happening is basically these states are issuing charters. Now, in theory, I guess in some theory, it's possible that we'd have state charter banks and still a small number of banks. The only thing is, if in, I don't know, let's just say Indiana, they issue charters and they're going to regulate those banks according to their rules. It's really not going to be practical for them to issue a charter and say, now you can do business in California, because California is going to say, just a second, you can't be sending your banks from Indiana into California and you regulating them in Indiana and saying what they can and cannot do. They're doing it to our people out here in California or in, you name the state, North Carolina or whatever. And so as soon as you say we're going to issue the charters at the state level and we're going to regulate these banks at the state level, then what you really are saying is we are going to keep these markets, these banking markets at the state level or smaller. You could, and that's what a lot of states did actually, is to say you had to operate within a county or a city or a couple of counties. But the point is that once we just say we're not going to have federal charters for banks, we're going to have state charters for banks, then what you say is we're going to have a whole bunch of small banking markets. And then as the population grows, then there's going to be more and more banks, but they're going to be constrained within either a state or a county or some metropolitan area and so forth, some smaller unit. And so that's where we get the thousands of banks, state charters. Now, what happened was this, 1863, and this is next on our list, we've got a president. Who's a president in 1863? Anybody? Abraham Lincoln. Lincoln was already president, was elected in 1860, took office in 1861. So he came along in 1863 and proposed it, and the Congress passed it, a National Bank Act. Here was what Lincoln observed. You know, we've got all these thousands and thousands of state-chartered banks. And we've got some states do a good job of regulating those banks, making sure the banks are solvent and so forth, and others do a lousy job. And so somebody will come up, in some states, somebody will come over here and they'll open a bank and they'll accept a bunch of deposits and then close their doors, take the cash and take off. And there are people losing money. And this is so uneven, this system of regulation, that it's just not working out. This was Lincoln's point of view in his administration. This is just not working out with the state charter. It's just too uneven in its application, and there are too many people being defrauded of their money by shady bankers. So what he did is he said this, let's come along here with this idea of creating federally chartered banks where it wouldn't be the first and the second bank in the United States, that kind of a deal. We'll have an authority in Washington, D.C., and that authority will issue charters to do business in any state, and will have a uniform set of regulations. And those regulations will basically keep these banks from defrauding people. And so there would be a new category of banks created, and by the way, this law passed, called the national bank. It's still a private bank, but it would have a national charter. And so today, if you see a bank and it's got that word national in its name, it's being chartered out of Washington, D.C. If you see the First National Bank of Minneapolis or whatever, the Third National Bank or whatever the number is, or Battlefield National Bank, whatever they call it, but if they put that word national in their name, then that bank has a national charter. Some banks have a national charter and don't use that word national in their name, but they'll indicate that some way or another. Anyway, so what Lincoln said is this: let's come up with a chartering agency, and the agency, well, poor spelling, the agency that would issue these charters was the controller of the currency, by the way, nowadays, sometimes you'll see that abbreviated, OCC, Office of the Controller of the Currency. You see how that is spelled. Sometimes people will pronounce it comptroller, C-O-M-P, hard P. Sometimes people just pronounce that controller as though it were spelled with an N. That's not really a big deal for us. But anyway, there is somebody there, an official in Washington, that's the controller of the currency, Office of the Controller. They are the ones that issue these charters. And this is within the U.S. Treasury Department. Secretary of Treasury sits on the President's cabinet. There's a Treasury Department, and within the Treasury Department there are several agencies and bureaus and so forth. For example, the IRS that collects our taxes is within the Treasury Department. Okay, well, one of the things within the Treasury Department is this controller of the currency. And so we've got an agency, and they came up with rules. In order to get a charter, you have to do this and this and this and this. Okay, and so those are minimum standards. You have to have a certain amount of capital. You have to have some officers. You have to have, a certain accounting system. And so they establish these rules if you want a charter. Now, the goal at the time and the intention was also to force all these state chartered banks to go and get a national charter or go out of business. That was the goal. We've got too much sort of fraud and corruption and so forth with the state chartering. Let's do away with that. The only thing is, they didn't have constitutional power to say, we're doing away with it. They can certainly issue a charter in Washington, but at the time, the interpretation of the Constitution is they couldn't say to the states, you may not do that. So what they did is this. They said, these banks are making loans, because that's what banks do, but a key service that banks offer is currency. People would come along with, could be foreign currency, it could be currency from another bank, it could be gold or silver, but people would come along and make a deposit in the bank, and the bank would give, these state charter banks, would give that depositor currency. Now you could just say, leave this in my account, okay, you've got a balance. But if you said, I want currency so I can go out here and buy groceries or whatever, they would give you their own currency. Each one of these state charter banks, thousands, could issue its own currency. And at the time Lincoln was elected, there were more than 10,000 different currencies in the United States. Wow. And so that was confusing enough in itself. It's like if you would go into the store, and now if you were handing over currency from just the bank down the street, they knew about that. But if, let's say that you went into the store and you handed over currency from some bank in Paducah, Kentucky, and you say, I just like to say Paducah, I have no reason for using that as my example. Anyway, if you hand over, it's like, here's a $20 bill from some, like the First Merchants Bank of Paducah, Kentucky, here's a $20 bill. The grocery store owner would get out like a catalog, open that up, and start turning the pages, looking for Paducah, Kentucky. And then here are the 7 banks in Paducah that have issued currency. Here's the, whatever I said, First Merchants Bank of Paducah, Kentucky. Oh, they've got the 1s, 5s, and $50 bills. They don't have any 20s. Hey, this is fake. Or maybe there is, but then it says, oh, this bank is only redeeming those at 80% of face value. But they would have to do a little research, and there were catalogs out for that, but they would have to do a little bit of research on currencies to find out if they're good. Because there are thousands of them, and this is more than people can keep them in their minds. By the way, if you'll remember, we talked about why does money exist, and we talked about the unit of account. And what we said is, if everything's just trading for everything else, there's so much information you can't process it. Well, there were thousands of currencies in, and there was so much there that you cannot process it in your head. It's not as though we had barter, it's as though we had thousands of different currencies, and there's just information overload, and people would be taken advantage of. And they try to deal with it with these catalogs. I'm sort of coming back to this story here. So Lincoln's idea was we got a lot of fraud here, partly with respect to the issue of currencies. We got a lot of fraud and uneven regulation and so forth. So what we'll do is this, is we'll come up with these nationally chartered banks. We can't do away with state chartered banks, but it does say in the Constitution that the Congress shall have the power to issue and regulate money. This is in the Constitution. So what they said is this. Lincoln said in his administration, what we'll do is, with our powers to issue and regulate money, we will regulate that currency out of existence. And once we regulate that currency issued by those state chartered banks out of existence, they'll go out of existence. And the only way they can stay in existence is to get a national charter, and then we will have a national currency that they can issue. And so part of all this legislation was, there was a national banknote. I don't want to overload you here with this, but a national banknote law came out in 1862. And so if you get a national charter, then you can continue issuing currency. If you want to keep your state charter, we can't prevent you from doing that, but we are going to impose a tax on your currency. And that tax is so high, you'll stop issuing it. And so now this thing that you've got to have to do business with your customers, you'll no longer have that. You'll go out of business. Are you with me on this? It's like, how do we enforce the National Bank Act? Well, we put the state charter banks out of business by taking away their best product. So what happened? The state charter bank said, we cannot issue our currency anymore. What are we going to do? Are we just going to go get a national charter? And some of them did. But then others said, hey, I got an idea. We can't have this currency anymore. Let's come up with a new product, a checking account. And so this is when bankers in the United States started issuing checking accounts to their customers, giving them the checkbook and so forth, is when they were no longer able to issue currency. And really a checkbook is, it's no different, right? Like if you've got a currency issued by some bank and you go, oh, hey, I wonder if this is good. I get the catalog out. Well, now all the bank said is, I'm going to give you this piece of paper and you can write in the amount. But it's still on the same bank. And the same amount of research has to be done. Is that bank in existence? Are they redeeming these pieces of paper and so forth? But you just fill in the amount. It's not a $10 bill. It's $10.27 or whatever you want to fill in, and then write your name on there. So anyway, that is the innovation of checking accounts. Not the first time they were ever done, but that's when they became big. So the state charter bank stayed in business. All of a sudden, you've got a few thousand nationally chartered banks, a few thousand, and you've still got thousands of state chartered banks no longer issuing their own currency, but now issuing checking accounts. And so the system became even more confusing. The idea was we're going to streamline this. We're going to force a lot of these small banks, and fraudulently run banks and so forth out of business. Everybody will get a charter at the national level. We'll have one national currency. That'll be it. And so what we got instead was one national currency, nationally chartered banks, a few thousand of them, and thousands of state chartered banks with checking accounts. And so this is all referred to nowadays as dual banking. And by the way, this is still with us. This has never changed. This is the thing about the United States banking system that is pretty unique. We've got dual banking where we have charters issued either by the national government, the controller of the currency, or by state governments. We have that today. Indiana, Missouri, California, Texas, you name it. Each one of them has a state banking authority that issues charters. And then there are national charters issued in Washington by the controller of the currency. And so now what we have is 51 bank regulators. We've got one at each state level, and we've got the OCC, the controller of the currency. Okay, so this idea of streamlining, that kind of fell by the wayside. By the way, in this state, we've got a state banking authority, and that is the Commissioner of Finance. Okay, and by the way, the commissioner is the one that signals Batman when there's an emergency. I'm just saying, you know, they put that thing up in the clouds. You see the bat signal? That's the commissioner. So we have got this really big mess. It's not a mess in one sense, if you like the idea of small and local and so forth, but it looks chaotic to the rest of the world. And there was an attempt to streamline it, to rationalize it, and it just didn't work out. Okay, so going forward, this is still mainly an agricultural country. There certainly were large cities and so forth, but mainly an agricultural country. Even by the year 1900, I'm going to say 40% of the population lived on farms. And today, this is just like, I don't know, 3, 4, 5%. But, so this was, at the time Lincoln did this, agricultural country. Okay, so we start going forward, and there's more and more urbanization. It's growing, but it still hasn't become dominant by 1900. But what is happening in the latter part, well, think about the Civil War came along, and what we start getting, I mean, there was this burst of construction of railroads during the Civil War. And companies started getting bigger. If you're going to build all these railroads, and I mean, if you go look at the numbers, I don't have them in front of me, but we go from having a few thousand miles of railroads to tens of thousands of miles of railroads in just like a decade. Partly this is, hey, we're trying to, you know, get the military and supplies and so forth across the country. But a lot of things are happening, and there's urbanization taking place. But if you start having lots and lots of railroads, then one thing you need is a lot of steel production. And so then steel companies start getting bigger. So you're getting bigger and bigger railroad companies and bigger steel companies. And big companies are coming along. And so what's happening in 1870, 1880, oil industry, and I can't tell you the exact year, but maybe around 1870 or so, there was a guy named Uncle Billy Smith that found oil in Pennsylvania. And boy, he had to drill about 6 inches underground to find it. Now, of course, we go down thousands of feet sometimes. But anyway, so we start getting in the oil industry, and then it starts small, but then it becomes Standard Oil. And so what's happening is, in the latter part of the 19th century, 1870s, 1880s, 1890s, we're starting to get bigger and bigger companies. And so at that point, which is not part of our banking story, but it kind of leads into it. So what's happening is there's this reaction that's developing, a political reaction in the latter part of the 1800s, and it is this populist attitude of, we got to regulate these big companies, they're bad. And what starts to happen is this, is some of these banks with the national charter, they start saying, you know, the state chartered banks are limited to what they can do by the state rules. They cannot jump over state borders. As I said a moment ago, Indiana can't say, oh, we give you the right to do business in, I don't know, Texas. But the national banks start saying, you know, we are chartered out of Washington, and we have rights to open branch offices and so forth, and they don't tell us that we've got to be in one state or another state or anything else. We've got a right to do business. And now that we've got railroads that are, you know, basically spanning the country, and we've got these huge corporations and so forth, sometimes we need to have, maybe our headquarters will be in Chicago, but maybe we need to have an office in Indianapolis and Dayton, Ohio, and different places like that. And so these nationally chartered banks start jumping over state borders into other states. And this movement is taking place. And then these banks start getting big. You know, it's like if you are limited to one state, then there's just, you can only get so big, because even as that state gets bigger, there will still be other banks competing for business within that state. But if you can just jump into any old state, you're looking out there and say, hey, there's a market that's not well served. Here's another, there's another. And so you jump into those markets that are not well served, and then what happens is you start getting a big bank. So banks are jumping over state borders, nationally chartered banks, in the latter part of the 19th century, early part of the 20th century. And so then in 1927, and this is like next on our list, I'll say 1927, McFadden Act. There's this populist reaction, political reaction to these big banking companies. And so there was a congressman named McFadden. He said, here's what I think the law ought to be. It was voted on, and it passed. The president signed it, and we get the McFadden Act. And here's what the McFadden Act says. You national banks, you have got to obey the branching laws that state-chartered banks have to obey wherever your headquarters is. So like if you are a Chicago bank with a national charter, you have to obey Illinois' branching laws. Whatever Illinois state-chartered banks can do with branches, if they can open all they want throughout the state, okay. If they can only open one office in the state, okay. Something in between, okay. But nationally chartered banks, you cannot use your national charter to jump over state borders and open up a banking company that operates everywhere. And so this McFadden Act officially cut our banking markets up into, now it would be 50, there were fewer states then, but each state is a separate banking market. And it's not only for the state charter banks, but also nationally chartered banks. You can't jump over that state boundary. The banks that had already jumped over the state boundary, those are grandfathered in. You can keep your branches if you've already jumped over. And like there were some Missouri banks that jumped over into Illinois prior to the 1927, and so they kept those branches. There was a bank, and I don't know if it truly was, but its name was the First Interstate Bank out west. I don't know where it was chartered, maybe originally California, but it had branches in several western states, Colorado, Utah, I think Hawaii. Couldn't have been Hawaii in 1927, but they had branches in several states. And then at 1927, they basically said, no more of that. No more jumping over the border. No more entering new states. But if you've got them already, you hold on to them. Anyway, the point is, in 1927, officially, we put a border around the state, and you develop your banking market within that state. Wherever you want your headquarters to be, nationally chartered bank, you stay in that state. If you're a state chartered bank, you have to stay in the state anyway. And so this is the prescription. We already had it working for us. There was to keep banks at the state market, state level, and to keep them small. The National Banking Act was an attempt to basically bypass that and make it where we'd have nationally chartered banks. And the McFadden Act was a reaction to that and said, no, we want you to stay at the state level. So we had thousands and thousands of banks. And I don't know the number, but I think maybe, I'll shoot a number out here, 25,000, 30,000 banks just at the dawn of the Great Depression. Like in 1929, I think there were 25,000 or 30,000 banks in the United States. At about the time most of you were born, there were around 14,000 banks in the United States. Okay, so thousands and thousands of banks. And it's because of, like I stated, state charters and then the McFadden Act. Any questions about this? This is kind of exciting stuff, huh? Here's a problem with that McFadden Act. lack of geographic diversification. There's this old expression about don't put all your eggs in one basket. Well, putting all your eggs in one basket is the opposite of diversification. Diversify means to spread your risk and don't like put all your money on black number 14 and spin the wheel and hope you win, but to diversify your risks or your bets or whatever. So if something goes wrong in one area or another, you're still in business. And so if you owned a banking company and you want to diversify, spread your risk, what you do is try to get in different parts of either the state or the country. And so if there happen to be really bad economic times in one market, you'll suffer losses there. And for a bank, bad economic times would be, hey, we loan money to people in Detroit, and now the car industry's having trouble. And so not only are the car companies having trouble repaying loans, but their suppliers are having trouble repaying loans, and the employees of the car companies are having trouble paying loans. Wow, that bank's in trouble. But if we diversify, what we'd say if we own this big banking company, okay, we'll have some offices in Detroit, but we'll also have some offices in California and Florida and so forth. And so even if there's trouble in Detroit, we have got other operations. They are profitable. Here's one that's not profitable, but the rest of the company is profitable, so we're going to pull through this. Okay, and so the McFadden Act says we're against that. We're trying to keep everybody all the banks in a small market area, and so what happens is if that market area has trouble, those banks will fail. This is pushing banks toward failure. And I mean, that's the effect of that. The state laws, the states already had these laws, and then the McFadden Act forced the national banks, nationally chartered banks, into this. But the states had three different kinds of laws: unlimited, statewide branching, some states had that. Those tended to be the states on the coasts, East Coast, West Coast. Some had limited branching, a county, a metro area, 2 or 3 county area, something like that. And then some states just had unit banking. Unit banking, no branches. One office, that's it. Pick a spot, put your building right there, your operations right there, no branches. These tended to be in the Midwest. It seemed to be like from the unlimited statewide branching on the coasts, and then as you head toward the center of the United States, you start getting limited branching, and then when you get sort of close to the center of the United States, that's where there was this greatest populist movement and this greatest suspicion of concentrated financial and political power, and that's where they just go one office, that's it. And I mentioned to you the other day, I think Texas had or has more banking companies than probably all of Europe. Hundreds and hundreds of banks. Well, Texas, for almost all of its history, was a unit banking state. So you just open up a bank and that's it. No branches. And so Texas it's a big area, and they have a huge population. What is it, like third largest population in the United States? Is that right, third, fourth? But I mean, big cities, Dallas, Fort Worth, Houston, San Antonio, Austin. Anything else? Can you hear me out there? And so it's got this huge population, and until recent times, it's like, hey, no branches. And so if you're going to have a huge market and no branches, then there are going to be lots of banks. Kansas was a unit banking state. Missouri, limited branching. What Missouri had, and it changed, but Missouri had a law that said something like you could have a main office, and then what you could have, I think if you go back 20, 30 years, I think they would let you have 2 other offices, 2 other branches, within the same county, and that would be for the larger population counties. And then if you got out into these small population counties, you could open a bank and then jump over to the next county and serve that market, which maybe wouldn't even be served at all. But there was limited branching there. Hey, somebody misspelled. Somebody came up here and erased that I. Okay. So anyway, in some of these cases, look at, we're going to have thousands and thousands of banks if we have unit banking. I went to graduate school in Virginia. They had unlimited statewide branching then. And so what they would have is like a home office and then, dozens and dozens of branches around the United States. Around the state. Now, here's what would happen in these states. I'm getting a little bit ahead of my story, but you go, boy, we can't open branches. This is terrible. What are we going to do? And so what they would do is they develop something called the bank holding company. So they said, oh, look, we've got a bank in one town. Let's say here's Kansas City, and there's another bank in St. Louis, and here's another bank in, Columbia, Missouri. And so then we'll create this bank holding company, and it'll own them all. And so each one of these banks will be a separate bank, but then they'll all have a single owner. And so these are not branches, they're individual banks. And by the way, each one would have 2 or 3 branches. But then they all have the same owner. And so then we've got this diversification, geographic diversification, that we weren't achieving otherwise. So it's basically, and this we've seen throughout history in the financial services market, banks are doing something, there's some objection from Washington, or whatever the state capital is, there's some objection. So a law is passed or a regulation is imposed, and then the bank says, we have to comply with that rule. How do we get around it? And so the rule on limited branching, they got around it by developing a bank holding company that would own banks, and each bank had its own charter. And so then the next step is, now we have to regulate bank holding companies. And so this was a matter of just playing this game back and forth. It's an important game, but they were basically going back and forth in terms of how to react to this. Well, in any case, I don't want to go too far here afield, but just to say that we've got thousands of banks because of the state chartering of banks and the McFadden Act. What happened, and it goes beyond just this issue of thousands of banks. But what happened was this. We get into the Great Depression. In the early days of the Great Depression, there were lots of bank failures. 1929, we're still talking about history here, of course. 1929 through, before I go on, another problem of McFadden Act and the state charter and the small banks was there was failure to achieve economies of scale. What companies frequently like to do, not every single company in every single case, but this is a general tendency, is companies think, hey, if we can get larger, we can become more efficient. Okay, if banks need computers, let's say, to do business, then if we had unit banking, every bank's got to have a computer to basically manage its business. If we have unlimited branching, we'll get one computer, and it can manage, and keep track of data and process that data and so forth for dozens or hundreds of individual branches. We want to be able to achieve efficiencies or economies of larger scale. Well, you can't do that if you're confined to these smaller markets. So these were the two problems of state charters and McFadden Act and having many, many smaller banks. Back to our 1929, we'll pick up the history right here. 1929 through 33, we got lots of bank failures. Okay, about 1/3 of all banks fail. And I've written down 1/3. That's an approximate number. You know, that's a lot of banks. If you just think about if you were in a city in modest size and there are 15 banks and 5 of them go out of business, it's going to be traumatic in a fairly short period of time. Now, here's the thing. At this point, economics is not very far developed. None of the sciences that study finances were very far developed. In addition to that, the regulations were not very strict. In addition to that, very little data were being collected. So you got all these banks failing. And since there's not the analysis, we don't really know, have a good explanation for what's happening. And since there's not the data collected, we don't really have the facts to work with anyway. And so in that situation, and this is really traumatic for the economy, in a situation where you've got this really traumatic situation like this, guess what people do? Everybody's their own theoretician. Everybody sits around with an explanation. Here's what's going on. Well, here's what's going on. How about this? How about this? How about this? And so in the final analysis, it's like, yeah, probably all of those are right. And so they just made up a bunch of stories. We would be making up stories if we lived through that. So I'm not saying, well, let's castigate these people. I'm just saying this is a reality, is they made up a bunch of stories. And some of the stories were things like this. You know, a lot of those banks failed because the stock market crashed in 1929 and they were speculating in stocks. We ought to stop the banks from speculating in stocks. Or they were making too many loans to people who did speculate in stocks. We ought to stop that. Or they were making a lot of loans to investors that were doing like really stupid things with the money. We ought to stop that. And there was just this whole series of stories. Bankers are, you name it, they're in businesses they shouldn't be in. We ought to stop that. So there's this whole series of stories and explanations about what happened. And by the way, later economists and historians went back and studied the facts and found out that not many of those held water. They were mainly just people who were traumatized without data and without the skills to analyze, who just came up with their own home-baked, by the way, most of these people are in Congress, but anyway, most of their own theories. And so what they did in 1933, they passed a law called the GlassSteagall Act. Okay, and this was all predicated on the idea that banks are speculating and like wasteful with money and not being careful and not conserving the deposits of people and so forth. But this is just, banks are run by lousy crooks, was kind of the underlying theory of it all. And so the GlassSteagall Act said this: we are going to come up with a whole series of bank regulations, a series of them. But the key idea is this: banks can only engage in activities closely related to banking. I'm going to put quotes around this. So the idea, and by the way, there was more meat put on those bones, but the idea is we're going to keep banks out of all these risky things. We don't want our banks failing like that, because when the banks fail, the people who put their money in the banks, they didn't get their money back. And so we got to do something about that. We will prevent banks from, we'll put a little line around the banks, and here's what banking is, and you stay out of every other kind of business. The other thing, and then we'll close with this, is that this created the FDIC, the Federal Deposit Insurance Corporation, that insures deposits. If you put your money in a bank and it has FDIC coverage and that bank closes, then you get your money back anyway. The government will come along, the FDIC will come along and make sure you get paid. Okay, but GlassSteagall was to restrict what bankers could do. And by the way, next time I'm going to tell you what's wrong with that: lack of diversification. We're saying all you can do is one kind of business, not other kinds of businesses. They're not diversifying their risk. That's where we'll close for the day. See you next time. So long.